Brad Williams, Frugal Finance, borrowing risk, default risk, and the cost of debt. When a bank lends to an individual or a company, there's a chance that the borrower will not make interest and principal payments on the borrowing. This prospect of default is called the default risk. In general, borrowers with higher default risk ought to pay higher interest rates on their borrowing than those with lower default risk. This section looks at the extent of default risk and the association of default risk to interest rates on borrowing, in contrast to the general equity risk in return models that measure the outcome of market risk on expected returns. Default risk models measure the results of company-specific default risk on promised returns, where diversification can be used to justify why company-specific risk will not be priced into expected returns for equities. The same basis cannot be applied to securities with a limited upside possibility and significantly larger downside possibility from company-specific events. To see what we mean by limited upside possibilities, think about investing in the bond issued by a company. The coupons are fixed at the time of the issue, and these coupons denote the pledged cash flows on the bonds. The best case scenario for you as an investor is that you receive the pledged cash flows. You're not allowed more than these cash flows, even if the company is widely successful. Every other development contains bad news, although in varying degrees, with the pledged cash flows being much lower than the promised cash flows. Therefore, the expected returns on a corporate bond is likely to reveal the company's specific default risk of the company issuing the bonds. Understanding default risk, the default risk of a company is a function of its ability to produce cash flows from everyday operation and its financial responsibilities, including interest and principal payments. Also, a function of how liquid a company's assets are, since companies with liquid investments should have an easier time liquidating them in a crisis to meet debt requirements. Consequently, the following proposition relate to default risk. Companies that generate high cash flows relative to their financial debt requirements generally have lower default risk than do companies that generate low cash flows relative to their debt obligations. Thus, companies with large current investments that generate significant cash flows will generally have lower default risk than companies that do not. The more stable the cash flows, the lower is the default risk in the company. Companies that operate in conventional and predictable businesses will have lower default risk than will otherwise similar companies that operate in cyclical or unstable businesses for the same level of indebtedness. The more liquid a company's assets for any known amount of operating cash flows and financial obligations, the less default risk in the company. For as long as there have been borrowers, lenders have had to evaluate default risk. Historically, measurements of default risk have been supported using financial ratios to compute the cash flow coverage. For example, the degree of cash flow relative to debt repayment requirements, control for industry effects, to sum up the unpredictability in cash flows and the liquidity of assets. Brad Williams, Frugal Finance. See you soon.